Thanks, Kurt.
So let's see if we make this work. Thank you very much for inviting me here. It's a real pleasure to meet with all of you and with my colleagues from MetricStream. As Kurt alluded to and you heard, I'm not actually from Chicago. But I hope I've got an illuminating story to tell you. It's taken a number of years to create this story, and I think it's got some lessons learned in it for everybody, both about overall project management and how you institutionalize something like this, and also about GRC projects in general. Some areas of focus, why it's been so important to us, why it's worked for us, what we see the real value is, some insights into why individuals and understanding how individuals operate within the program is important, how we thought about and designed ours and what we think made it successful, and really how to make it part of the organic organization. Just briefly, the Federal Home Loan Bank system, we're actually a cousin of two other more famous GSEs called Fannie and Freddie. At one point we used to actually own Freddie Mac, but now the 11 federal home loan banks, which are separate entities, they're a bit like the Federal Reserve banks. The districts are different. Don't ask me why the districts are different. But they support housing finance and the banking system in general across the United States. Their membership, their customers, and also their stockholders are credit unions, insurance companies, community banks, community development financial institutions, and state housing authorities. And they provide liquidity and funding for all of their activities. And in fact, in the crisis of 2008, the federal home loan banks, without doing any special policy changes, injected several $1 trillion into the financial system long before the Federal Reserve started to react to that demand for cash. In Chicago, we're a $70 billion bank. We support over 700 members in our districts, which is the states of Illinois and Wisconsin, so we're quite a small geographical area, providing them with very low-cost funding, basically at the same rate the federal government funds at, although we're not guaranteed debt by the federal government. We also purchase mortgages and provide liquidity for members by purchasing mortgages. And we also provide an important, and indeed I think the largest private funder of affordable housing in the country. So we all like not paying tax. Well, the federal home loan banks don't pay tax, but they do spend a proportion of their income has to go in mandated affordable housing programs. That leaves us with an interesting paradigm because we're a large regulated financial institution, but at the moment we're about 425 personnel in our facility in Chicago. So we're not a large organization by people size. So a little bit of the context of this, and those of you in financial services will recognize all that this is going on. The regulatory expectation over the last few years has just gone up dramatically. I'm sure you've heard about that in the last few days. It's provided a particular challenge to audit and risk committees. It really has driven an expectation of the board in particular, and then the board has driven that down onto management to provide them with information and provide them with insights into how the organization is governed. And indeed, that's had to even more be demonstrated to those regulators how we do that. And what we've tried to engender in the Home Loan Bank over the past, I guess this story takes about 12 years to evolve, certainly since I joined the bank. We've tried to see risk management and governance and compliance as an organic part of our organization that actually allows us to succeed. What we're trying to do, sometimes we succeed better than others, is not see it as just an overhead that we've got to deal with because there's a regulator knocking at the door, but something that actually enables us to operate more effectively, sometimes because we can respond to that regulator more effectively, but that really allows us to develop and bring our organization forward at a pace that allows us to serve our stakeholders and our shareholders better. This was some research that showed that in US banks anyway, the organizations that had nimble and effective risk management organizations and compliance organizations tend to have a much greater return on capital. And that allows them to perform that much better. So as you think about this, there is now, certainly when we started, there wasn't this sort of research, but there is now substantive research that if you're good at this, it has a positive benefit to your stakeholders. It's not just a compliance exercise. So back to the story. The genesis and the challenges of where we went, some of the strategies we used to develop them, quick insight into what our environment looks like, some of what we've accomplished, and some of where we're going at the moment with the overall strategy. Where we came from, I alluded to this earlier, and this is back in 2005, 2006. We had enormous regulatory pressure. We had slipped up, you might say, in a big way. Our regulatory reports were getting thicker and thicker, which is never a good thing. You want really thin regulatory reports. And the regulator was becoming increasingly concerned about how we governed the bank, how we risk managed it. And at the same time, we were trying to do some other little clever things like registering with the SEC, which the regulator had insisted on, which meant Sarbanes-Oxley was coming on top of us. And the immediate reaction of the organization was to hire a lot of people and to create a lot of spreadsheets and create an enormous amount of overhead. And as we did that, we were trying to change products because the regulator was pushing for changes in our product dimensions and how we organize that. We had interesting relationships with our stakeholders as we decided to withhold a dividend and other things like that. Our directors were getting very concerned, not unnaturally. Ultimately, that would end up in a cease and desist order and various other little interesting regulatory artifacts. And overall, the overhead of the business was accelerating beyond our ability to make money in a relatively low margin business. So where we went with that is, and I don't even know that we'd heard of the words GRC, but we went down a path of trying to consolidate and integrate as much as we could. We had to really provide a much more transparent reporting framework to our board. Our board was getting bombarded with reports from various different organizations within the organization, whether it was the legal group, the compliance group, the audit group, the risk management group, the SOX controls group, and they were all giving them different lists of outstanding issues and outstanding controls and how we were managing it and what was working and what was not working, and the board was thoroughly confused. So we're really trying to provide a lot greater level of transparency for our board and our executives. We also had managed to generate a culture at which people were just interested in complying with whatever the regulators said or whatever management said, and not thinking about it and what it meant for us and what it meant for our business. And we really felt a need for people to step back and take accountability for what was going on. And lastly, in doing all of that, we hoped to dramatically reduce our costs and our overhead, and it's not just hard dollar costs, but the soft dollar costs of managers turning around every day and looking in their email and going, oh God, I got another spreadsheet I've got to fill in for another oversight unit. So how do we do this? Well, the key, frankly, was never miss a good crisis at this point. We had really strong buy-in from a CEO, from a chief financial officer. Surprisingly enough, the chief audit executive was quite happy about it. The chief risk officer and our business leaders were all highly bought into, we need to do something different. And we need to do it fairly quickly and declare success around some core objectives. We looked at a number of different frameworks and ways we could do this, things that were important to us. We prioritized where we needed to go, so early quick hit was issues management, for example. But generally to get to one model for most things. And we didn't try, we thought, to take on too much too quickly. So we knew what our short-term goals were, and we had a long-term vision, and that vision, certainly even today, continues to evolve. Challengingly, we managed to sell everybody a conceptual framework. We said, we don't actually understand all the details of how this is going to work, but here's the big idea. And we brought everybody into the fold, and you know, it really helps having a C-suite that's on board, and when people are like, well, that doesn't work for me, they're kind of like, well, you've got to work out how it's going to work for you, because it's going to work one way or another. So we were really able to bring people into the fold and the strategy. Like I say, tactically, we brought our issues management process together first, and we were able to declare success, and the board was able to put its thumbs up and say, this is fantastic, I've just got one spreadsheet that tells me what the outstanding issues in the organization are and how they're prioritized and when you're going to get them fixed. And that, just doing that was a huge success and enabled us to really vindicate the process. We managed to bring other stakeholders in. So I was a stakeholder as an audit executive, but we managed to work very closely with our risk management people, with the people who were managing our financial controls infrastructure to really move to a single view of what it might look like. At the same time, we were trying to knock off a couple of tactical things. We just wanted less spreadsheets. If we had less spreadsheets, we believe we'd be in a better place. And I mean governance and risk type spreadsheets specifically, though we could talk about others. We wanted to deliver transparency, so every time we could simplify a report or collapse 5 PowerPoints into one PowerPoint, we thought that was a positive thing. And we were really pushing for some integrity in that reporting. What we had found is, as we had multiple reporting frameworks, multiple reporting processes, there was a lack of integrity, which then destroyed the credibility of the information you're reporting to management. If the board could look at 2 reports in their board packet and say, well, this doesn't make sense. You've got 72 issues on this one and 71 on this one. What's the difference? And you go, oh, it's a timing difference and apples and oranges. It really isn't a helpful thing to be talking to your leadership about. So I talked about how we brought everybody together. we really had that entire C-suite working together. We had the major business organizations working together, the second and third lines of defense all integrated. And to a greater or lesser extent, we brought in the regulator and the external audit partners. Though, as we've evolved this, they have become a secondary stakeholder, if you like, not a directly integrated part of the process. So, talked a little bit about it. What were we trying to do? Well, after getting that issues management into one place, the other things we really worked on were bringing the business units and the business risks and the controls all into one core central repository. We brought all the key oversight groups that manage those things, like our operational risk management group. FIG is our financial reporting risk management group. Our compliance function and internal audit, who in our organization is the only people who actually have to go out and validate that any of this works, or certainly at this point it was, into one so that we were talking about one universe of objectives. And we tried to bring in all of these different components of the overall governance environment, regulatory reporting. Where's it done in the organization? How does it tie in? What are the controls around all the different processes we have going on? What regulations are we trying to comply with? What operational risks are we trying to manage? And then we tried to identify a set of risks we were going to manage. And we started with a very top-down approach. We had, I think in the organization, I counted at one point 6 different risk models, depending on how you were going to cut the cake and which organization. Technology risk had their own risk model, operational risk had their own risk, our enterprise risk management had their own, our financial people had a different one, compliance had a different one, and then audit probably had another one. We consolidated around a set of risks, and we said, this is it. Whatever we do in our organization, it has to fit into this list. Caused a lot of heartache up front, but actually, it survived 12 years. It's still the same set of list of risks, and everything seems to fit into it somewhere. And the ability to be consistent has really shown up. So what do? We bring together the compliance program. We have a process for sucking in new regulations. We have a process for identifying and adapting our SOX controls. We've now had to integrate a new set of prudential standards into that. So that's one big input into our risk framework. We've integrated our management risk assessment, and when we started doing this, that was really an annual process and a significant overhead in and of itself. It's now an organic process, much more. We reevaluate both in internal audit and the management organization, our risk assessments continuously now. We used to have to do a whole separate set of fraud risk reporting, because one of our regulators asked for that. That's now been integrated. We had a similar thing which we had to do for money laundering. It's been integrated into the process. Event reporting, technology incidents, and how we manage the change management within the environment. And these are now all pretty much business as usual. We don't even think about it. If somebody walks in the door tomorrow and asks for a fraud risk assessment, it won't actually be a big deal, and we'll give them the fraud risk assessment as of the night before. It isn't 6 months old, it's as of the night before, because that's when it was last updated. Now, that maybe it's the same as 6 months before, but it is constantly being updated. And then we integrated independent reviews as well. So, and this was another big area where we lacked consistency. So certainly those of you who are in the financial services space, you probably have model validation teams and compliance functions and people coming in doing SOC 1 reviews, people who are doing independent reviews, consultants coming in doing reviews on behalf of the business, penetration tests on your technology stuff. We've brought all of that information together into a central place, so it's integrated in, it has a standardized way of reporting. We identify every time there's an issue in one of those reports which of our control elements are being impacted, and we can all think about it in a very consistent way. So what has this really meant for everybody? I guess there's a common theme in the word integrated. It's very integrated, but there's also, if you look at this picture, an awful lot of those little stickmen picture people. A lot of this is not about the technology, but it's about the people and making sure that they are educated, have bought into, it's part of their lives. So, you know, yeah, there's a blob up in the top right-hand corner that says MetricStream, but the big important thing is everybody is using the same data set. They talk to the same people about the same language when they're thinking about these things. And we have either the data is actually uniquely within that integrated infrastructure, so that infrastructure holds our risk and control library, or it's integrated into it through some sort of interface. For instance, our general ledger account structure and chart of accounts is not held in there, it's held in the general ledger, but there's a periodic resynchronization process, and every general ledger account is cross-referenced into that library, as are all our vendors and all our assets and other attributes. As our frameworks, to the extent that we use them, and all of those things. It's not all done perfectly. It's not all done through the technology. There's still the odd manual spreadsheet. There still is some human intervention to make it all work properly. So this is more trying to describe what our actual environment looks like, and certainly this is how we started it off. We talk about our business as 5 main core business products, and these aren't organizational products, these are business processes, these are the things that we face the outside world with. And those are the vertical silos here. This is where we lend money to people. This is where we buy mortgages from people. This is that community investment activity that I mentioned earlier, where we're funding affordable housing across the country. And then the other side of that equation, if you like, if you're an accountant, is we have to get money from somewhere. So we issue an awful lot of debt on the world capital markets, and somehow we have to balance the interest rate risks between the money we lend out and the money we bring in. Those are the ways we face off against the outside world. That is not an organizational construct. And we think that's very important. So it doesn't matter when we reorganize the bank or we change our org chart. This idea has remained incredibly static over the last 12 years, with relatively little tweaking. We've been able to maintain that stability, which also means we're not making masses of changes, which also means we have continuity between periods. We understand the risk assessment. As we do, for instance, a risk assessment, we know how it aligns with these products. And it's been an interesting thing for those people, those business people, to understand how they might be accountable for one of these silos, but they aren't actually in control of it all. So each one of those silos will include operational aspects, it'll include delivery aspects, it'll include whatever the relevant compliance aspects are, it'll include the settlement activities and things that go on within that process. In the horizontals, you see how we then look at our organization horizontally, and we identify a number of areas which are really not outward facing, such as our financial management, such as our overall governance and strategy at our executive level, how we run technology and operations, how we do certain administrative things like internal audit that cross all areas of the business, things like our market risk management capacity. Again, remarkably consistent. Believe me, like most organizations, we've been through multiple personnel changes and restructurings and rebalancing. This organization has survived all of that. And certainly in my history, before we went down this path, I used to spend every year half the nightmare of creating an audit plan or a risk assessment every year was somebody'd rejigged the whole organization in the last 12 months, and I had to rebalance the whole thing and explain it to people that apples were oranges and how it didn't go together. This idea has managed to eliminate 90% of that frustration. And we literally are recalibrating it every year as things change, or maybe a new regulation comes in, or we re-emphasize parts of our business. And that's really allowed us then to collaborate and explain much more consistently to all our key stakeholders and understand much better how things fit together organically. You know, event management is a classic example of where we can do that now. Instead of thinking about, did the ABC unit make a mistake or get something wrong, we're thinking about how does that impact a whole business process. They may think it's very, very important, but maybe it isn't in the bigger scheme of things. And on the contrary, they may see it as relatively unimportant, but actually the downstream consequence within their business process might be much greater, and we can actually see how those things integrate and come together. We can do the same thing when we do financial reporting and you're doing key control assessments. I will admit, every so often a control goes wrong. It doesn't always work, and we have to have a long conversation with our public accountants about what the impact of that is and where the compensating controls are. Well, because all the controls are aligned down these business lines and are aligned with the general ledger, we can rapidly demonstrate where the compensating controls are that are relevant to that area. We can also demonstrate where there aren't any compensating controls, which is a much more interesting conversation to have. And for my team, it's made them, I think, much better performing because they have a much better view of what the organization is and what the processes are and what the risks are that they're trying to evaluate. They're no longer looking at a single business unit as defined by a human resources org chart. They're looking at a business process and what the risks are within that business process, and are relatively, totally, hopefully, indifferent to what the organization is that's underneath that. So, what are some of the things that have been the outcomes? We think there's been significant benefit to it. It's frankly probably harder to see today than it was then, because now this is part of our DNA. So many of the people we talk to don't even remember how terrible it was before. But we have a consistent way of evaluating risk. It's highly consistent. It's becoming more consistent. It's now consistent at the level at which we use the same risk assessment model, whether you're in enterprise risk management, operational risk management, business continuity, even maybe technology, if you're doing model evaluations. all of those areas are basically using the same risk model and the same language to talk about risk and what their priorities are, which is just a subset of the overall idea that we've got a very consistent way of talking about business processes and talking about risks and what we're managing. We have very consistent risk reporting now. It's not that we don't debate it or that it's always identical, but we no longer spend much of our time explaining why there are differences in reports that are artifacts of the way the reports are structured or the model that's underlying them. We're talking about what are the real differences in opinion or metric that we're measuring because we measured it differently. We're able to look at things over a time frame. We're able to measure how things change over an extended period of time. We're able to look at the changes in our risk framework and control statistics and understand how that's impacting our organization. What we have seen, certainly in this short period, and I apologize for the artifacts of PowerPoint conversions, I guess, but the risk, the way that our these bottom charts show the number of issues we were tracking over like a 2-year period. Over a 2-year period, we saw as we started to track stuff consistently, provide the metrics to people, we just saw, you know, the low-hanging fruit getting knocked off a lot more quickly and people being able to focus on what was important and get things resolved. Cost wasn't our top priority, but it's always an important priority. As we implemented this framework early on, we saw a significant reduction in headcount. Some areas just stayed flat, other areas came down dramatically. Probably the biggest winners and losers, financial report, we basically eliminated our SOX risk management department. It came down to one person by the time we'd finished with this, because that's all it really took to run the logistics from a financial reporting perspective. So we continue to have an end-user computing aspect of this. It's mostly in the interfaces and how we get data in, how we manage our data. We're trying to eliminate that. We really have implemented now pretty much an evergreen risk management program. Our operational risk people are refreshing it on a rolling basis by business unit. In internal audit, we're probably a step ahead of that. We actually refresh the entire risk assessment every couple of months. We've integrated an element of continuous monitoring and continuous control evaluation into the process. We continue to try and do that. That's a real core objective. And the nice thing about that is we now have several business leaders who basically, if there's a new process, a new compliance aspect, and believe me, we have new regulations all the time, the first thing I've said in the meetings, they ask their staff is, how are you going to get this into the framework and get it into the system? I'm not interested in you generating another Excel spreadsheet and showing me how this works. I just want it automated because I know you can do that. And overall, this process is becoming less part of the second and third line of defense and much more part of the first line of defense and how we actually manage operational risk and compliance risk as we move forward day to day in the business areas. So it's not all perfect. It certainly cost a non-trivial amount to maintain this infrastructure. We think it's significantly less than the overhead it would be if we ran it all on the back of an Excel spreadsheet. as one example, this is actually our third technology iteration in this evolution, which was really as necessity occurred, as the idea was more and more successful, we outstripped the technology and needed to implement better technology to make it work. But the idea has been consistent right the way through this process. All business units have to participate. There is a real human aspect to this. You have to bring people along. That can be challenging. That may mean you have to kind of find a circle of friends and eventually show how successful it is, and other people will join the club. That's certainly a strategy we have used occasionally. There is a level of overhead. I would argue it's certainly no worse than the overhead you're going to suffer anyway in the current compliance environment. And, you know, on the upside, that integration has a real positive to it. You generate a lot of documentation. I'm not a huge fan of documentation, but in the current regulatory environment, if it isn't written down, it just doesn't count. Whether it's my external auditors and the PCAOB who's on their back, or my federal regulators, if I can't demonstrate it on paper, then or a PDF file, they really it just doesn't work. So being able to have everything in a consistent and coordinated, documented place has a real benefit for the organization. So where are we going? We're in the process of integrating some of the other things that go on that are really important in the organization, and certainly flavor of the month. Business continuity is actually planned, is probably pessimistic. It's in process at the moment. So our business continuity colleagues have basically just adopted the framework, said whatever we're doing before, yeah, we'll try and leverage that, but we're just going to suck up the organization and the framework that is in place for the rest of the organization, and we're going to suck up their risk assessment model and really integrate those together. Vendor risk management is now using a very similar model, and we've integrated their data into the overall framework. Model risk management, which is like a separate validation group within our organization, and certainly many financial services companies, just adopted the whole framework out of the gate. They had nothing, so it was a relatively easy place to go to something, and we literally just cloned what we actually do in internal audit, and they used that out of the box to make that work for them. And then what we're doing, have done, continue to improve is really to integrate all of the data in the organization, be it from applications, locations, end user computing, into the model so that we better understand the integration between all of these things. You know, an interesting thing we're doing at the moment is we just created, you'd think this was fairly straightforward, but we just created an inventory of all our regulatory reporting, which is just a little bit scary. And then we're bouncing that up against our list of applications and end user computing to see where it comes from. And we figure we're going to find some gaps in that process, either spreadsheets we didn't know about or reporting we didn't know about one way or another. And I showed that very simplistic diagram of 5 products and however many horizontal layers. We've developed that a bit. We've taken that down another layer. So we found, you know, within each product, a handful of sort of sub-dimensions. And we've started to get a little bit more granular about those things. And interestingly, that was probably mostly driven by things like business continuity management, because within a product, not every sub-product is as important as every other one. So that was very much a derivative of some of that work. Likewise, it increased the complexity by an order of magnitude the moment we started to do that. So there's definitely a payoff equation as we work through some of that stuff. And we continue to try to get things more integrated. So finally, why does it all matter? Well, I talked about cost savings. I talked about the confidence of the board. There's also a real element of confidence in executive management. We know what we know, and we're not surprised very often by things. We're able to demonstrate to our regulators. We have an exceptionally burdensome process whenever we want to do anything. And believe me, most of what we can do is governed by act of Congress. So you know how fast Congress moves. Trying to do something new is a little bit of a challenge. Every time we do want to do something new, the fact that we can demonstrate where the controls are, how we manage that, we can demonstrate that we have managed similar risks in the past, allows us, we believe, to move forward much, much faster on those things. Albeit, we've still got the bureaucracy to deal with, but even they are more confident that we're confident that we know what we're doing as a result. We know what we do well, we know what's replicable, we tend not to reinvent the wheel if we've already got a process in place. We started off way back when, I think at one point we had like 400 key controls in the organization. Now that might have just been key SOX controls. We whittled that down to about 60 over a couple of years, because we found that actually most of them were just variations on what somebody else was doing, or they were something that somebody did, but they weren't really key. But having that centralized repository allowed the CFO and some other people to sit in a room and go through that inventory and go, okay, we're just going to have one control design for, I don't know, I'll pick on something, doing a reconciliation or balancing or something, and leverage that multiple times rather than having every flavor of it across the organization. And that allows us, when we want to do something new, we have a model, and we're really focused on what the newness is, not reinventing the wheel about all the things we really know how to do already. And because of those constraints, certainly most things we do are a flavor of what we were already doing. So that really kind of wraps up where I was going. Hopefully I've given you some idea of what the benefits are of integrating all of this stuff together, what some of the key strategies we use to make it happen, why we think it's worked, and somewhat where we think we're going with that story. So with that, thank you. Any questions?
So all the risk management application you have implemented at the same time, or you have started one by one?
Say that again.
All the risk assessment, like for your regulatory, for your antivirus, or credit or finance, whatever the list you have you implemented all the applications at the same time, or
no?
You started one by one, or
absolutely not.
What's the approach you have used?
Right. We started with a model that was really, I think we really started with the audit risk assessment, and then our enterprise risk management group said, oh, that's neat, that works. We're going to do that. So then it became both our risk assessments. And then, you know, as other groups have come along, we've pushed, cajoled, persuaded that that's really the model that everybody should use. So, no, we started somewhere, demonstrated success, and then pushed it out. Does that mean we've had to tweak it? Absolutely, we've had to adjust it, but it's mostly been refinement rather than anything else.
Right. You?
Okay, we could probably take maybe one or two more questions because I want to get you all off to the other session at 10:30.
On the downside slide, there was a reference about the level of administration of the program. Could you share what is the structure, what are the responsibilities, and how many people have this role of administration of the program?
Sure. We survived for, best part of 11 years without having anybody formally, dedicated to the product. So it was a shared responsibility. Some people might have spent more time on it than others. And actually, our current leader is at the back of the room in there, and he now is our sole body who is full-time responsible for the product. So we finally got to the point, and it's mostly because of bringing in all those different groups that I was talking about, that there's enough maintenance work and supervision required to do that. So before that, we were, frankly, it was somebody's part-time job. And that worked. When we originally implemented both MetricStream and its predecessor, I think one of my staff worked on it for 3 months flat out, dedicated, but that was a kind of one-off. Then you go back to your normal day job type exercise. So it's got an overhead, but it's not huge. And when I think about having one person spread across our organization, I think that's a pretty reasonable payoff within the equation.
Okay, any last questions? Great, Tom, thank you so much for your time and presentation.